The budget's increase in the inclusion rate for capital gains has drawn criticism. One observer said it adds a choke point to people investing money in the economy. Our guest, however, says this particular tax change is, in fact, defensible. We're joined by Trevor Tombe. He is a professor of economics at the University of Calgary. Trevor, thank you very much for giving us the time.
My pleasure. Great to be on.
If I may, I'll summarize the argument you make in an article at thehub.ca, and you'll correct me if I get it wrong. We're going to focus here on capital gains when people sell shares in a company. Now, you know companies have many ways to distribute value, including dividends and share buybacks. And you say an efficient tax system is one that doesn't bias such decisions. Each should face similar taxes. So you're saying that if profits are paid out as dividends for a top-rate taxpayer, it leaves about 45 cents on the dollar in after-tax income. But right now with the capital gains system, it's higher. I'm not sure we can go back to that chart, but something like 54 cents would remain with the investor. But increasing the inclusion rate brings that down to about 48%, closer to the taxation on dividends. So I think part of your argument here is that the different tax treatment can distort a company's behavior, maybe inclining them to stock buybacks rather than dividends. And the tax system is supposed to avoid that effect. So you're saying there is a case to be made for this increase in the inclusion rate.
That's right. You summarized the argument I put forward in the article pretty well. And I guess before adding some additional insight there, I should note, obviously that a change in taxes is going to come with winners and losers, pros and cons, and it's much more complicated than just one particular aspect of this policy decision that I lay out in the piece. But it is important for the tax system to the extent possible, not bias the decisions of corporations making decisions about how to send value to their owners. And having similar treatment of dividends versus capital gains is something that our 50% inclusion rate was originally aiming at. When we lowered it from 75 to 50, I guess about 20 plus years ago, that was because capital gains had a much higher effective tax rate on it than dividends. And so that reduction was bringing those closer together. But now we've seen the reverse, where dividends have a higher tax rate all in applied to them than capital gains. And this change does better align not just those two sources of income, but it even aligns it very well with interest being paid to lenders or labor income being paid to workers. And so with this change, we have a high degree of uniformity. And this doesn't mean that one should support tax increases or not. I think you could have seen the government taking the incremental revenues from this change and lowering personal income tax rates by potentially 5 points at the top. So this didn't need to be a tax increase, which does lower incentives to invest and grow. But this alignment improvement between capital gains and dividends shouldn't be neglected.
In my naivety, I always thought that capital gains were taxed at a lower rate in order to encourage people to buy shares and take risks. But that's not the idea here?
No, that's not the primary motivation for the partial inclusion rate. The main reason why we treat capital gain only partially as income is because capital gains distributed to owners have already been taxed at the corporate level. And so that partial inclusion is there to avoid double taxation, where we tax the returns both at the individual and the corporate level. And given where corporate taxes are and given where personal income taxes are now, an approximate inclusion rate of about 2/3 is what delivers that alignment. Although, as I noted, 50% delivered that alignment historically. Back in, say, 2010, for example, 50% was the right number. So there's no single right inclusion rate. Anytime we change corporate tax rates, we'd need to think about adjusting that inclusion rate to maintain the alignment.
And I mean, I suppose some capital gains, say a person selling a second home, it's going to be taxed at a higher rate. And I mean, that seems fair enough if we want a progressive tax system. I know we can't get into that, but I mean, certainly, owning a second home doesn't really add value to the economy.
Investing in homes or investing in building assets certainly adds value, no question there. And part of what makes entrepreneurialism and innovation and those types of investments important is that they do create value. And you're right that this increased inclusion rate does increase the tax rate on those returns. And so previously, each dollar in additional value that you earn through capital gains in a second home or building a new business was taxed at 27 cents on the dollar for a high income person. And now it'll be taxed at 35 cents on the dollar. So it is a roughly 9 cent on the dollar increase for those types of gains. Although note that 35% on the dollar is still far less than the roughly 53 cents on the dollar that we have for the top end personal income tax rates. So there still is preferential treatment for that particular type of investment. And that's where I think the conversation's kind of gone off the rails in some quarters in Canada. We could have lowered personal income tax rates to compensate for this this effect of increasing the inclusion rate on those particular types of capital gains.
Before we go, Trevor, you put out a tweet today saying that one fundamental thing we should remember about the tax system is that it's good to cut income taxes and raise spending taxes. Just walk us through that, would you?
Sure. So generally, things like the GST, a consumption tax, are potentially much more efficient in terms of facilitating investment and economic growth because they're taxes on the use of our income on consumption rather than on the returns to investment or work effort, if you will, which are more productive. And so shifting taxes away from income and towards consumption could really move the needle on economic growth, in facilitating investments, growing the economy. And that's something that's separate from capital gains inclusion, I think we really ought to think more about.